$376 million in debt. That's what Hooters was carrying when it filed for bankruptcy in March 2025, on a business whose company-owned restaurants brought in only about $359 million in a whole year. The debt nearly equaled everything the company earned. And behind that debt stood the very same Wall Street firm that had just driven TGI Fridays into bankruptcy 5 months earlier. Two of the most recognizable restaurant brands in America collapsing within months of each other, run by the same private equity firm, with the same playbook. This is the story of how private equity bought a billion-dollar American brand, mortgaged its own name for hundreds of millions of dollars, borrowed $70 million more, and used part of that loan to pay its own owners. It's the story of how the price of 10 chicken wings climbed to nearly $18 while the food got worse and the buildings fell apart. Nearly 6,000 workers, more than 400 restaurants at the peak, and a debt load that nearly swallowed everything the company earned. When it was over, the men who'd loaded on that debt walked away, and the original founders bought the wreck back for a fraction of its worth. This is who got rich while Hooters fell. It began in October 1983. With something far simpler. On October 4th of that year, 6 businessmen in Clearwater, Florida, opened a restaurant almost as a joke. None of them had any real restaurant experience. They picked a name that was a double entendre, dressed the servers in orange shorts, and bet that cold beer, chicken wings, and a certain kind of casual irreverence would sell. They were right, and then some. Hooters didn't just succeed, it created a whole category of American restaurant, the kind the industry would later call, with a wink, the breastaurant. Through the 80s and 90s it franchised across the country and around the world. It sponsored race cars and golf tournaments, launched its own airline for a while, and became a fixture of American road trips and sports Saturdays. At its height, Hooters had more than 430 locations and rang up something close to $1 billion in system-wide sales a year. You could love it, or you could roll your eyes at it, but you knew it. It was woven into American culture, the sports bar of record, the punchline that was also, undeniably, a real and profitable business. But by the 2010s, the ground was shifting under it. Tastes were changing. The casual dining sit-down model that Hooters belonged to was losing share to fast casual chains and delivery apps. And the culture itself was moving. The formula that had defined the brand for 30 years read very differently in a post-Me Too America than it had in 1983. A smart owner would have spent money modernizing the concept, refreshing the menu, and rebuilding the buildings to carry the brand into a new era. That takes patience and investment. It is the opposite of what was about to happen. Because a real, profitable business with a recognizable brand is exactly what private equity collects. The ownership of Hooters changed hands like a baton in a relay. In 2011, the firm HIG Capital, along with a partner and the chain's largest franchisee, acquired Hooters of America. For most of that decade, the brand drifted, losing ground to a wave of imitators, Twin Peaks, Tilted Kilt, and others, that copied the concept and chipped away at its edge. In 2018, HIG ran an initial securitization, raising around $300 million against the brand, and then put the company up for sale. In July 2019, 2 firms bought it. One was Nordbay Capital, a low-profile outfit out of Tampa. The other was TriArtisan Capital Advisors, out of New York, the very same firm that at that exact moment also controlled TGI Fridays and held a stake in P.F. Chang's. The terms of the Hooters deal were never publicly disclosed. But what came next should sound familiar, because it was the same financial machine that would later grind up Fridays. The first move was to pile on debt, and then to mortgage the brand itself. In August 2021, a vehicle called HOA Funding LLC issued a whole business securitization. Just like at Fridays, the idea was to bundle Hooters franchise royalties and its brand into a separate legal entity and borrow against that future income, roughly $315 million of it. The company's own name was now collateral for the people who owned it. And the financial research firm Octus flagged something unusual in the structure. The implied management fee, The slice of collections that the people running the securitization could take worked out to around $22.5 million a year, about 28% of retained collections. The industry norm for these structures is closer to 16%. Otis called it on the high end. Now, whether that full amount flowed to the PE owners as cash or stayed inside the securitization vehicle has never been publicly confirmed. Otis describes it as an implied structure, not a documented payment. But what's clear is that the machine had been set up to route an unusually large share of the brand's cash toward the managers at the top. Then came the clearest single act of extraction in the entire story. In March 2022, with revenue already under pressure, Hooters closed a $70 million senior secured term loan, and the official press release stated in black and white that the proceeds would be used in part to fund distributions to its ultimate parent entity. Read that again. The company borrowed $17 million against its own operations, and the stated use of proceeds included, in black and white, distributions to its ultimate parent entity. How much of the $70 million actually went out the door to the owners was never disclosed. But the intent is right there in the filing. This is the textbook setup of a dividend recapitalization. You don't wait for profits to pay yourself. You borrow, and you let the company carry the loan. The owners get cash today. The restaurants get the bill tomorrow. Now do the arithmetic that the people inside Hooters had to do every single day. By 2024, the company was paying $30.9 million a year just to service its debt. Its company-owned restaurants generated about $359 million in revenue. That means roughly 9 cents of every dollar that came through the door was spoken for, gone to lenders, before anyone paid for rent, for wages, for chicken. On top of that, the company owed a legacy royalty of around $4 million a year on certain stores, draining cash that could have serviced the debt or fixed the restaurants. When that much of your money is committed before you open the doors, you have only two levers left. You cut costs and you raise prices. Hooters pulled both hard. On the cost side, the company deferred maintenance and let restaurants visibly decay. It became notorious for paying its vendors slowly, by some accounts taking roughly 4 times longer than the typical chain to settle its bills. Restaurant Business, the industry trade publication, documented the pattern bluntly in an article literally titled, "Another Example of Private Equity Excess." On the price side, Hooters pushed the cost of its signature wings from roughly $1 a wing to $17.99 for 10. And, in 2021, at around 160 corporate locations, it put servers in skimpier uniforms. A short-term grab for attention that the brand's own founders would later say cheapened it and drove away the families they'd spent decades courting. It is the single most self-defeating combination in the restaurant business. Make the product worse and charge more for it. As one industry critic put it, any strategy that reduces quality and raises prices at the same time is particularly boneheaded. Customers noticed. Between 2019 and 2024, Hooters' U.S. sales fell by 31% and its store count dropped by a quarter. In September 2024, a ratings agency downgraded the securitization notes, citing the revenue decline. In 2024 alone, the company closed 48 restaurants. The debt that was supposed to be serviced by a healthy brand was now strangling a shrinking one. By early 2025, the math no longer worked at all. On March 31, 2025, Hooters of America and 30 affiliated companies filed for Chapter 11 bankruptcy in the Northern District of Texas. The filing laid out the wreckage, about $376 million in debt, 5,957 employees, 151 company-owned restaurants, and 154 franchised ones, a $40 million emergency loan, $35 million in new money, plus a $5 million roll-up, was arranged just to keep the lights on while the company looked for a buyer. There was a bidding contest. One competing group valued its offer at over $110 million. But the buyer that won, in the end, was the past. Over the spring and summer of 2025, a group built around the brand's original founders, operating as Original Hooters, moved to take the company back. On October 30th, the bankruptcy court confirmed the plan, and a day later it took effect. The private equity era was over. The founding group took control of roughly 140 of the 198 surviving U.S. locations, plus the international stores, and converted the chain to a pure franchise model. Here is the bitter symmetry of it. The founders bought their own creation back out of bankruptcy for a fraction of what TriArtisan and Nordbay had paid for it in 2019, and in doing so, the brand shed the entire $376 million of debt that private equity had stacked on top of it. The new chief executive, Neil Kiefer, would tell Fortune that the previous owners had gone too far down the road of making it more like a little boys' club hangout, and set about undoing it, putting the families back at the center of the brand. So, who got rich? The private equity owner's equity was, on paper, wiped out. But along the way, the structure they built had taken a management fee on the high end of the industry and had paid distributions to the parent with borrowed money in 2022. The bondholders who held the securitization notes negotiated their recoveries near the front of the line. The lawyers, the financial advisors, the restructuring firm, the lender who supplied the bankruptcy loan, they all got paid, as they always do. And the people who didn't get rich, the nearly 6,000 workers, most of them part-time servers and cooks, who lived through years of closures and uncertainty, never knowing which location would be next. The franchisees who had bought into the system and now watched the parent company collapse around them. The customers who watched a brand they recognized get more expensive and less appealing, plate by plate. And in the longest view, the brand itself, a genuine piece of American culture, handed back to its founders only after a decade of financial owners had wrung it dry. It is worth being precise about the lesson, because it is easy to tell the wrong one. The comfortable story is that Hooters died because America outgrew it, that the concept simply went out of style. There is some truth in the cultural shift, but plenty of dated restaurant concepts survive for decades on modest, steady profits. What Hooters could not survive was the math, a debt load nearly equal to its entire annual revenue, layered on by owners who needed the brand to perform like a growth stock just to stay current on the loans. The cultural headwind was real. The debt is what made it fatal. Because this was never really a story about whether America still wanted Hooters. It was a story about debt, about a viable business made unviable, one mortgage at a time, and the proof is in the pattern. The very same firm, TriArtisan, had run the very same play at TGI Fridays, with the very same securitization weapon, and reached the very same intangibilization weapon, and reached the very same ending just 5 months before. Two American giants. One financial machine. And in both cases, the question is the same one this channel always asks. Not how the company died, but who walked away rich while it did.